past year represented a sea change in the investment world, with rising inflation and interest rates laying the groundwork for 2023 to be economically difficult for many individuals and businesses. Last year, the UK FTSE All-Share Index was flat, and the FTSE World ex-UK Index was down 7.7% in sterling terms. But it was an exceptionally tough year for fixed interest investors, with government bonds falling 25% and corporate bonds down 19%. It was a year in which accepting risk paid off. During Q4 and into the new year, there has been some relief for markets, as sentiment has improved, in particular in the UK, where firmer ground has been found in the public finances. This means the path of interest rate rises is lower than following the disastrous mini-budget in September. We are likely past the peak rate of inflation. In the UK, the 12-month CPI rate hit a high of 11.1% in October, before falling marginally to 10.5% in December. And in the US, the largest world economy, inflation peaked in June at 9.1% before falling to 6.5% in December. The reason for the difference is largely down to the respective cost of energy. We should expect inflation to fall further and perhaps sharply, which of course means the motivation to increase rates is lower, not that a reversal to the cheap money of the past decade that fueled rising asset values is on the cards. But what is not so good for borrowers is good for savers finally. And after years of next to no returns from cash, rates of over 3% on short-term fix are now available. The lagging effect of higher rates on the UK economy, though, has not been fully seen. Although companies are beginning to announce financial results showing lower profit expectations due to weak demand and higher costs, in particular in meeting inflation-adjusted wage demands. In general, these pressures could result in company valuations continuing to fall over the coming months as they wash through. However, financial markets are usually ahead of the curve and will begin to improve before the economic data provides evidence, which is what makes predicting the movement of markets so difficult and why it is important for investors to ride out periods of volatility and stick to the longer term plan.